Hello and welcome to this week's episode for Conservative ETF Investor. I am your host. My name is Ken, Senior Market Analyst for Conservative ETF Investor, and our model portfolio for SPY is up 0.14%. The year just started, folks. Don't expect miracles here. So we only have 2 trading days under our belt, and we're just pyramiding into our positions. So we're going to start the year off. We start the year off with 0% return on investment. And then throughout the year, as we trade the portfolio, that is how we build our portfolio. Just in case anybody has short-term memories, in 2024, the model SPY portfolio did 37%. And the buy and hold investor for the S&P 500 did 24%. We smoked them by 14 percentage points in 2024, just last year. So right now it's a small number because the year just started, only 2 trading days underneath us. So that's that. I want you to follow me to beat the returns of the market. And of course, this is Warren Buffett, one of the best stock investors of all time. And then here I am, Ken Cogliano. We do have a red signal for the stock market strength color signal, and we'll go into great detail on that later on in this video. All right, this video is for retail investors. This is going to be a full monthly end video content. So what I do is at the end of the calendar month, I do one full video, and then in the middle of the month, I do intra-month videos, and I try to make them shorter. I'm trying to give you guys as much content as possible, and I also don't want to bore you to death. I think the content is absolutely priceless content because this is the decisions that I'm going to make in order to determine how I want the portfolio to be positioned. And I'm sharing that information with you guys, the YouTube audience. We're going to do a deep dive into the technical analysis for the S&P 500, and we're going to review the NASDAQ 100 and small caps charts. We're going to review last week's trades. We're going to look at how the model SPY portfolio is doing compared against the benchmark of the S&P 500. We're going to look at the federal funds rate and the current Fed policy. We're going to review the bond market. We're going to look at the U.S. presidential election cycle theory. We're going to go into interest rates and look at the yield curve, CNN business, fear and greed, seasonality, ratio charts, the VIX, which is the fear index. And at the end of the video, we're going to go through the market summation, closing thoughts, and next trades. Let's get to it. Okay, here are our past returns for our model portfolio. In 2024, we did 37.29% compared to the buy and hold investor, 24%. We smoked them. Now in 2023, not as impressive. We did a return of 14%. The buy and hold investor did 24%. So they did beat us by 10 percentage points in 2023. In 2022, the S&P 500 return, the buy and hold investor, was negative, just about 20%. We were up over 20%. Now that's huge. When you have a negative market and you're not able to look at those, experience those losses, and you experience gains, and then you get gains on top of that, that's really helpful on your portfolio growth. Okay, last week, the returns for the markets for the S&P 500 for the week was down 0.51%. For the NASDAQ 100 QQQ, down 0.76%. And for the IWM small caps, up 0.92% for the week. Okay, now we're going to look at trades that we made last week in the SPY model portfolio. I have 4 portfolios under my belt, SPY being one of them. I'm only sharing with you, the YouTube audience, the SPY portfolio. The other portfolios are for members only. Now, last week we did send out 2 trade alerts. The first one on 1/2/25. That is going to be this trade alert right here on this candle right here. And you'll see that the year ended, and the year and the month ended on this candle, December 31st. So we could start our trading here on January 2nd because the market was closed January 1st. So this is where we could start our trading. And before this day, you can see that the market was traveling south. But what I saw was the market hit a bottom and it started to advance up. And right at this point, when the market was at 588.04, that's when the trade alert got sent out. Hey, let's take on 50 shares, or about 23% of the portfolio. The very next day, I saw the market open, begin to travel south, but then it recovered and began to travel north. At this point in time, I said, hey, let's go ahead and put some more skin in the game. The trade alert went out. Let's go ahead and put on another 50 shares, or another 23% of the portfolio in. And that trade went out at 592.09. Now the market is slightly backed off of that number right now. So in that second transaction, we're just slightly negative on that transaction, but overall positive between the two transactions. And you can see how I'm pyramiding into the position. It's not all or nothing, folks, what I'm trying to say. So we can determine how much of a percentage we want to put our money at risk on. And I'm sharing with you what I am doing with this portfolio. Okay, here are the trades for the SPY portfolio that we've put on in 2025. I just went through them in the last slide, and here they are in an Excel spreadsheet. Now, I put down here in yellow because these trades are still open, they're not closed. And I just so that I can come up with a portfolio value, I put in today's date, the day that I'm producing this video. So 1/4/25, just so we can have some type of resemblance of how much the portfolio is currently worth and how we're doing on our trades. So in the first trade, we're up $195. The second trade, we're down $7. But the overall portfolio, okay, so I should state that we are starting the year off with $130,000. That's going to give us enough money to buy 200 shares of SPY, plus about another 10% in order to play with options when I feel it is necessary to play with options. Right now, I don't feel that way, so no options are in the game right now. But throughout the year, that may change. And if it does change, we need some capital in order to put that money to work. Here is the 4 portfolios that I am tracking for my subscribers. The one that I'm sharing with you, obviously, is just SPY. If you want to see how I do this, I want you to go ahead and smash that like button down, subscribe to my channel, and ring that bell to be notified when I post a new video. If you want to be a member and sign up, you can go to this website right here. The link will be in the description down below. On that link, you can sign up to be a member. You can choose the plan that you want to participate in. Also, that's for real-time trade alerts. Now, if you would also like to see past trades, you can go to my website over here and you can review past trades. I also have my Excel spreadsheet on how I track my trades, just in case you want that same spreadsheet. You can get that for free at my website. Okay, now we are looking at an equity curve for our model portfolio in blue against the S&P 500 buy and hold investor, which we're going to refer to as the benchmark. This is what we are trying to beat. Now, the benchmark is currently up 1%, but they had an advantage that I didn't have. Their portfolio started at the closing price of December 31st. I didn't even consider start trading the portfolio until January 2nd, the first market day that it opened in the new year 2025. So they do have an advantage there, but that's just that small advantage. And they're fully invested. I am not fully invested. We only have about 50% invested in SPY at this time. And I'm going into it in layers, and I'm pyramiding into the position just so that in case this market turns south in a fast hurry, we don't get caught with our shares at risk, the whole portfolio at risk. So I'm tempering how much of the portfolio is at risk just in case things start heading south. Now you'll notice that we do have the entire year here, we have a blank slate. So now that we've got this blank slate, we're going to see what the S&P 500 is going to do during the year, and we are going to trade accordingly. Okay, here's the Fed chair, Mr. Jerome Powell, and this is the 2025 FOMC meetings. This is the calendar for those meetings. The next announcement is going to be on January 29th, so the end of the month. Are we going to get a rate hold, cut, or hike? At this point in time, I don't think we can call it. Originally, the Fed chair said we're going to have 4 rate cuts in 2025. You can see here that there's plenty of meeting dates here. But he changed his tone at the last meeting in December, where he says the expectation now is to only have 2 rate cuts in 2025. Well, out of all these months here, which 2 is he going to choose for a rate cut? Who knows? So at this point in time, we don't know what exactly is going to happen on January 29th, but I doubt it's going to be a cut. Most likely, it's going to be a hold. All right, now we are looking at a chart of TNX, which is the 10-year U.S. Treasury yields. That's going to be the candlestick chart. In blue, we have the S&P 500. In black, we have TLT. That's 20-year bonds. I have a couple of moving averages in there. The green is the 50-day. That's this one. And the 200-day moving average is in black. Okay? Now, what is bonds doing? Or the 10-year yields, what are they doing? They shot up like a rocket ship, came down and shot up again. Well, that's a low, that's a higher low. That's a high, that's a higher high. Rates are moving up on the 10-year. This is somewhat concerning. Now, we do have an old high here, taken right here, so we have not breached this old high right here, and we appear to be moving sideways at this time. So rates are definitely elevated and appear to be moving sideways. Now, down here on the MACD, you're above the signal line, but you'll notice that clearly you've topped and you're starting to lower your trajectory. It looks like it's going to be, and look at the histogram here. This is heading south. This looks like it's going to head south. The slow stochastics was getting ready to cross below 80 on its signal line, but instead it went up and it's kissing its signal line right now. So it kind of looks like it's going to be moving sideways. So I don't expect, what I expect out of 10-year yields right now over the next week is sideways action. All right, now we are going to take a look at the presidential election cycle theory. All right, we've just started 2025. And depending upon the year of the election, you have historical rates of return for the S&P 500 and also down here for the NASDAQ 100. Right now, we have in 2025, well, Trump won the election in 2024. He becomes inaugurated January 20th. So right now, we're still under Joe Biden as the president until the 20th. But right now, he's the president-elect. And just for purposes of my video here, we're just going to say that the president for 2025 is Donald Trump. All right. Now, what happens to the S&P 500 the year after the election? That's this year, 2025. The election was in 2024. Now it's the year after. Historically, the S&P 500 does 6.7%. Now, where are we at right now? The buy and hold investor is up 1%. So there's plenty of room between now and December 31st for the market to gain, let's just say, another 5.7% and still be within this historical normal average. So we do have that. So from that perspective, the market would be considered bullish because generally speaking, you're going to increase between now and December 31st, 2025. From looking at this from an historical election cycle theory. Now we are going to look at the bond market. Now, down here I did a Google search. Which is bigger, the bond market or the stock market? Bonds and bank loans form what is known as the credit market. The global credit market in aggregate is about 3 times the size of the global equity market. Equities is the S&P 500. The stock market, the stuff we are investing in. That's this whole video. My whole channel content is on stock investments. Or equities, equity investment, okay? But we want to pay attention to the bond market. It's 3 times the size of the stock market. Generally speaking, there's more research that goes into the bond market than the stock market. And the people that run the bond market, those investors, generally speaking, are smarter than the average retail stock equity investors. So we want to pay attention to what they're doing. Now, right now, the yield curve is normal. As of today, 1/4/25, I pulled up the rates for the 91-day, the 2-year, and the 10-year. And you'll notice how the 10-year has the highest yield, 4.6, 2-year, 4.28, and the 91-day, 4.23. That is a normal yield curve. Now, what else do you have going on? You have rising interest rates. If I take the 10-year yield, 4.6, you compare it to 1 year ago, 3.93. That's a rising interest rate environment. Generally speaking, equities do not do well in rising interest rate environments. Now, we've been rising for some time, so you don't want to base all of your stock investments off of this one granular piece of information. I'm just putting out their generalities. Here is Warren Buffett, the Oracle of Omaha, and over here is CNN Business Fear and Greed Index. We want to monitor our current reading on the Fear and Greed Index of 32 to 1 week ago, 30. So we are traveling this way on the Fear and Greed Index, but not by much. And generally speaking, we're in the fear department. And generally speaking, you want to be fearful when others are greedy and be greedy when others are fearful. Others are fearful right now. So, from this perspective, which you could say is contrarian investment strategy, you want to be more greedy at this point in time. All right, now we're going to take a look at seasonality. Now, down here, we are currently in the month of January. This is a look back of 5 years. This is a seasonality graph. This is the percentage of months in which SPY closed higher than when it opened, going back 5 years. For the month of January, you have a 60% probability that the month of January is going to close higher than when it opened the month. Currently, for the month of January 2025, the S&P 500 SPY is positive by 1%. So from this perspective, we already have accomplished that goal. And between now and the end of the month, I should say we have a 60% probability of being positive, going back with 5 years of data. Now over here, we have historical rates of return going back all the way from 5 years to 30 years for the S&P 500. Historically, we should average somewhere between 7 and 10% for the year. Currently, the S&P 500 is only up 1%, giving plenty of room for this market to advance between now and December 31st and still be within the historical normal average. So from this perspective, we are in a bullish condition. Now, we're going to stay on seasonality for a second. We're going to do a 10-year look back and a 15-year look back. Focus on the month of January, 60%, 60%. So 60% probability, it's still the same, 5, 10, and 15 years. All right, now this chart here, which I got at this web address right here, it tells you how the stock market, the S&P 500 specifically, has done on a percentage basis since 1930. Now, currently, we're in the month the years, well, this one here is 2025. This here is 2024, and this one is 2023. Look at the 20% line and draw that line and go across. What I'm trying to point out to everyone here watching is that for the previous 2 years, the buy and hold investor has advanced more than 20%. Going back all the way to 1930, how many 2-year in a row advances do you have greater than 20%? Let's start over here in the 1930s era. You have these 2 years right here. What happened the following year? That's the year we're in now. That was a massive negative decline. Judging by this graph, it looks like that was about a 40% decline, or a good 35%. Now let's keep moving on. Over here, you have 2 years back-to-back 20% gains. The next year, not so great, maybe 3%. Keep moving down the line, looking for 2 back-to-back years. This almost had 2 years of 20% returns. Let's just say it's close enough. The next year, down by 10%. Let's keep moving on. This one we're not going to qualify. No, 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 no. Now over here, this section, this is quite fascinating. You had 1, 2, 3, 4, 5 consecutive years with 20% returns. That looks like from 1995 to 2000, or something like that, right in that neighborhood. Unbelievable. 5 years, 20%. Boom, 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 boom. Wow. But going back all the way to 1930, that only happened once. Is that going to happen again? This is the future. It's unknown. We're looking at probabilities. Do we have any other times after this period that we have back-to-back 20% returns? This one's kind of close, but no. So just our current one right there. So when you go and look at all these years that you had 20% returns, generally speaking, on a percentage basis, the odds favor the next year, the year we're in right now, to be not an impressive year and possibly a negative year. So keep that in the back of your mind on risk. All right, this is a monthly chart. This is a line chart, so the one that's in red and black for the S&P 500. I have a bunch of moving averages right here. You can see right here all these exponential moving averages here. It kind of gives you this ribbon, okay? And what does this chart telling us? Now, keep in mind, this chart is going back 20 years. We have 20 years of data on this chart. You can see the massive bear market here in 2009, and the market took off and basically hasn't looked back since. But between now and 2009, you did have a massive, let's call that 20% correction, and then a 25% correction. Here we are right now. We're way above the ribbon, and we are moving north on the S&P 500. So with that, we want to just be alerted for telltales when this is going to start pulling back into the ribbon. See here, pull back into the ribbon. Here, pull back into the ribbon, into the ribbon, into the ribbon, into the ribbon. So it's not uncommon for the market, especially after it's had a nice run, to pull back in. So if that's the case, you're going to go from your current level, which is 591, pull back into the ribbon, come back here, could theoretically get to something around 500. So we certainly don't want to experience that much of a loss in our portfolio. So we want to keep an eye on this. Now, the MACD is extremely elevated, 48.701. It's only happened 2 times since well, since the SPY portfolio has been around, okay? And the last time that it happened, the market experienced a 25% correction. So we are back at that elevated level. It looks like it's reached somewhat of a topping pattern. It's definitely, its angle of ascent has changed trajectory where it doesn't have such a strong angle. Still above its signal line. We want to keep an eye here on the slow stochastics. Once it starts getting below 80, the reason that that's going to happen, this is probably going to be start pulling into its moving averages. So we want to definitely keep a tight eye on this. The last thing we want to do is have our portfolio experience a 25% correction like the buy and hold investor did in 2022. Now, this is a weekly 5-year look back candlestick chart for the S&P 500. Now, here you have a bearish rising wedge pattern. This pink line is support, this blue line is resistance. We have broken down out of the rising wedge formation. I have a blue line here with this line here. So this solid line represents the possibility of how much this market's going to drop. And this blue line represents that support right around 540. Will we drop that much? Unknown. And are we going to continue to drop? Well, from this chart here, which is a weekly chart, from this chart, we're looking like the MACD is traveling south and the slow stochastics is traveling south. So, and we've come out of a bearish rising wedge formation to the downside. So from this chart, I would say we're definitely in pullback mode, we're in bearish mode. Now we're going to look at the S&P 500 daily candlestick chart going back 6 months worth of data here. We have our cycle brackets drawn here in the bottom. Look, this low represents that low right there. This one, that one, this one, that one, this one, that one. This one is possibly that one or that one. I'm not 100% sure yet. Let's look at it this way. If this low is that low right there, and this market went sideways and then tanked, that is a left-hand translation, very negative. So if that is the low right there, this market has just experienced in this cycle right here, a left-hand translation, which generally speaking is a bearish, very bearish activity. We did come up, but we did not surpass the old high. So that is a lower high as of right now. Now, with that said, we did not make a lower low. That low did not get taken out. So if that low is going to remain intact, and we just crossed above the 50-day moving average, and if we can hold and stay above that 50-day moving average, and look at the slow stochastics, you'll notice a low and a higher low. Trajectory is up. We're getting ready to go above its signal line. On the MACD, you can see how we bottomed and it is curling. Look at the histogram bars traveling north. It looks like this market wants to go north right now. Even though the cycle brackets are telling you that the low, if depending upon how you establish your lows, if that is the low right there, that means the next low is due over here. Possible we're going to continue to pull back. So it's not quite 100% sure how this is going to play out. We have some investment. Showed you guys we're about 50% invested. So if the market does decide to tank, we're not taking the full 100% hit like the buy and hold investor. But if the market decides to take off, again, we're not going to get the full 100% gains. We're only going to get 50% of those gains unless we start putting more skin in the game. But right now, it actually looks, I'd say that this chart looks more bullish than bearish. I like the way the MACD is looking. I like the way the slow stochastics is looking. I like the way that we just crossed above the 50-day moving average. So, and I like the fact that we did not make a lower low. So if I take all this information, I'd say that we are traveling north to at least the bottom of this valid trend line, taken from that low and taken from that low. See, the line is drawn right across here. I'd say that at least we're going to come up and kiss the underside of this valid trend line, at least. And then we'll see what the market does at that point in time. Now we're looking at a ratio chart. This is the NASDAQ 100 against the S&P 500. The ratio chart is the one that's in red and black. We also have the S&P 500 in blue, and we have the NASDAQ 100 in black. You'll notice that the NASDAQ and the S&P are traveling north. The ratio chart reached a bottom, it's traveling north. Down here on the MACD, the histograms have stopped, the bars have stopped going down. You can see here in the thumbnail, and they're just traveling sideways, giving it room to allow it to start to curl up. The slow stochastics clearly has bottomed and just about ready to cross above its signal line. So from this perspective, I'd say we're risk on. All right, now we're going to look at another ratio chart. This is the RSP, equally weighted S&P 500 against SPY, the normal cap-weighted S&P 500. The ratio chart is the one that is in red and black. In blue, we have the S&P 500. In lime green, you have RSP, the equally weighted S&P 500. You notice that when you have a good bull market, the equally weighted S&P 500 surpasses the normal cap-weighted S&P 500. And when you go into the toilet on the ratio chart, that's because the cap-weighted S&P 500 is surpassing the equally weighted S&P 500. If that's confusing, I'm sorry, but that's basically what is happening here, okay? Now, what this channel, what I want and what I like to do is I like to get easy money. It's difficult, and for new stock investors, this can be a little challenging to understand. But there's easy money and there's not so easy money. Easy money is when the market is traveling north and there's really good evidence to support that we have a bullish market and you can stay long with confidence. When the market starts getting into trouble and you start heading south, well then that if you're going to make money during that time frame, that's more challenging in order to make that money. And right now, with this ratio chart going down into the toilet, this is that time where, like you'll notice in the past, when you started traveling down in this low range on the ratio chart, well, the S&P 500 here took a 19% bath. Over here, when the ratio chart was moving sideways, the S&P 500 experienced a 40% bear market. Now, the ratio chart's gone into the toilet, and the S&P 500 has stayed positive this entire time. No 19 to 40% decline. This is 20 years of data, folks. So there's a tremendous amount of information on this chart. So we're not yet at a point where I'm going to tell you that we're going to make easy money, but I'm going to show you right now where the easy money is, and I can see it on the chart. It's when you hit this point. When you hit this point right here. In other words, when the ratio chart is moving sideways and then finally breaks out and heads north, that is the beginning of your bull run for the S&P 500. Here, you see that the ratio chart broke out, and when it did that, you got a very good run of the S&P 500 moving north. That, my friends, is easy money. We're not there yet. This ratio chart is still in this trading range down here. This is a weekly chart. Doesn't move so fast. It's not a daily chart. So it doesn't make transitions until the end of the calendar week. So right now, the easy money is not in front of us yet. So we're waiting for that bar to appear in this sideways action. When that happens, my trading is going to change. We're going to start putting on, heavy investments, and we're going to start putting on leverage. In other words, we're going to make great bankroll when the market tells me that the easy money is there to be had. It's not there yet. I would not be surprised for the market to experience some type of a decline between where we're at now and that easy money signal. I want you to stay with me. Stay tuned to this channel because I monitor this on the full monthly videos. When this comes up and when I see that easy money, I'll let you guys know. All right, now we're looking at the VIX Volatility or Fear Index. That is the candlestick chart. 3 ranges. Above this range, this green line, the upper range, bearish. Below this green, above this green line, low range, bullish. Below this green line, that's the ultra low range, bullish. Where do we stand? We are right between the low and the ultra low range. We're right there on the chart. MACD moving sideways. Slow stochastics has topped. It is traveling down from a fear index. We are bullish right now. We're okay to have skin in the game on the S&P 500. All right, this here is the Think or Swim platform. This is the S&P 500 3-year weekly candlestick chart. We have standard deviations, +2, -2 in gold, +1, -1 in pink, the halfway line dashed green. Now, where the market is right now, here you can see that rising wedge formation that I talked about earlier in this video. And you can see how we've broken down out of that. And you can see this blue line where it is possible that this market could pull back to. I've got here 3 alerts that this platform is going to automatically send to my cell phone. If this market starts traveling north and we break 608.55, I'll get that alert. If we come down and tag this low made by a cycle low here, I'm going to get an alert at 568.88. And if we slice through that and we continue to decline, then this bottom here, which is the projected moving target range for how much it drops when you come out of a rising, bearish rising wedge, that's going to be 537.67. So are we going to come down that low? Maybe. Basically, I know that we're moving north right now, but if we go to tag the underside of this bearish rising wedge, then we could possibly come back down and come like that. So right now we're experiencing upward trajectory. We may be experiencing what's referred to as a dead cat bounce. We'll see. We'll try to trade it accordingly. Now, with that, let's go over and change it to a 1-year daily. Change our cycle brackets to 1-year daily. And here we have a little bit more information. Let me get rid of that. So I have an alert on this trend line right here. Let me just get rid of that. So that way, if we do break this trend line right there, I'm going to get alerted. Now here, I've got cycle brackets drawn at the bottom, and I've got the major and minor. This low here, this low here, this low here, this low right there. This cycle here, moving north, definitely positively configured. This cycle low here, you can see that one moved north. That's a positively configured cycle. This cycle low might be that one right there. If that one is that one, hang on a second. If that's that one and that's that one, then this market just got a neutral cycle. I've got it identified right there as a neutral cycle. So we'll see how this is going to play out. What's interesting here on this platform, let me just show you this so you can see that. When you look at that, on this platform, which is interesting, the 50-day moving average, we have not crossed above the 50-day moving average. It looks like we tagged the 50-day and we got rejected off of it on this platform. On the other platform, which was stockcharts.com, it was above the 50-day moving average. So let's wait until next week to see how we do. Down here at the MACD, looking actually good. I'm liking that chart. Looks like it's moving up. Slow stochastics reached a bottom, traveling north. So we have 50% skin in the game. Let's see if that money if that money is actually going to go to work for us. Now, let's go ahead and look at the NASDAQ 100 daily chart. Let's switch this over to daily. And I got an alert there, but let's take that out for now. Okay, so what is the NASDAQ 100 doing? The NASDAQ 100 is looking stronger because you're making higher lows, generally speaking, higher highs throughout. But you just recently started to get some downward action on the NASDAQ 100. This is the daily chart right now. So right now it's kissing the bottom side of this valid trend line. We'll see if it has energy in order to break up, or is it going to did it just reach a ceiling and break down? It's unknown right now. Let's look at it on a weekly basis. All right, we're going to go over to 3-year weekly and look at weekly brackets. Now, looking at it on this time frame, you've got here a valid trend line here and another one drawn in here. The market started to get more aggressive, and I drew in this aggressive trend line here, and we did break down out of it. So it is now looks like it's in pullback mode is what it's doing. So but if you look at this last candle, I mean, the way that the candle is positioned, it, came down, took out some bears, and then went up and closed here at the high. So on a weekly basis, that's not a bad looking candle. That might be the bottom. Oh, excuse me, let me get rid of that. And we might start traveling north from here. So we'll see how this one does. I got it listed here as pulling back on the weekly analysis because you can see it pulling back there. Now let's look at IWM weekly chart. Now this one here trades unbelievable. Oh, one other thing I want to point out here. Let's go back to SPY. You'll notice that on the standard deviations, how they're traveling from left to right. They're traveling north. QQQ, standard deviations traveling north. IWM, standard deviations traveling north. So all three of them are in uptrends, okay? The angle that you see on the standard deviations, that tells you, what's happening. So you can see how the standard deviation lines are traveling north. So the market is traveling north. And this is a weekly 3-year look back, okay? Tells you right here, 3-year weekly chart. All right. Now, we did way back over here, did tag the bottom of the -2 standard deviation and then traveled and tagged the +2 standard deviation and have since pulled back. Where do we stand right now? We do have a low here and a low here that I'm calling, and I got a valid trend line drawn in here. Then the market started to go at a higher angle, like a blow off top. So I drew in another valid trend line until it got taken out. And when it got taken out, it got sliced through. But since that massive down day that happened here 3 weeks ago, the market's been moving sideways. Look at the last candle, last week's action. This is a bullish engulfing candle because the body of this one completely envelops the body of the previous week's candle, and it closed here at the high. That looks bullish. Remember at the beginning of the video when I talked about, how each week, each index did, the S&P, NASDAQ, and QQ, and the IWM. Well, the small caps IWM, the chart you're looking at right now, was the only one that was positive last week. Now, let's switch over and let's look at a 1-year daily here. Let me get rid of these lines. And let's go to 1-year daily on the cycle brackets. And let's see what this has to say over here. Now, here you're moving sideways, but look at this line that I have drawn in here. You also have your standard deviations, and you'll see that we came here to above the +1 and then totally cratered, came down. There's that big negative candle that you saw, part of that big negative candle, because this is a daily, the other one was a weekly. But we've been kind of moving sideways. As of late, we're starting to look like we're having some bullish activity. Look down here at the MACD. The histogram clearly shows that it's traveling north. Slow stochastics already above its signal line, traveling north. We need to really take out that low, that high right there. Just 226. Right now we're at 224. We need 2 more points. If we could take that high out, then the new candles here are going to start making higher highs. Once that happens, we can be off to the races for more advancement here in small caps. Now, this is an Excel spreadsheet that I created in an effort to determine the health of various asset classes. You have equities, real estate, gold, precious metals, bonds, emerging markets, and world markets. And then down here is the 11 S&P 500 sectors broken down per sector. All right. And the highest number you can get on the screen is a 6. So anything with a 5 or a 6 gets the color green. The more green on the screen, the healthier things are. We also want to compare the current reading to last week's reading. So you'll see when it comes to various asset classes, things are deteriorating, folks. We went from 26 down to 13. This graph here is so ugly. The only thing that is this float is the NASDAQ 100. But that is not a bull market by any means. Now, let's look at the 11 S&P 500 sectors. Last week, 30. This week, 29. We need the number to be greater than 35 to get out of the red zone. We're in the red zone. So I think that we're going to experience a dead cat bounce, but this information shows you that things aren't really that rosy. There's a lot of deterioration here. And I want to be very quick, put money on the sidelines and not have our portfolio at risk if things start acting squirrely. So this market is not a market that you can just leave your money and just set it and forget it. 2025 is not going to be that type of market. Okay, that is going to take us to the conclusion of this video. As of January 4th, 2025, the market summation, according to me, Ken Cogliano, Senior Market Analyst, your friendly host for Conservative ETF Investor. The market is deteriorating, as noted by the red on the color strength signal. Caution is advised. I do see a market bounce happening right now, which we all love to call the dead cat bounce. And we will continue to add more shares if we can hold the 50-day simple moving average. If this is not a dead cat bounce and this market is going to continue to move north, well, we want to participate in that. But I need the market just to prove itself along the way. I'm not going to put all my eggs going long until I see this market moving north. Now, even though I make these statements, the market is an 800-pound gorilla. And this 800-pound gorilla is going to do whatever it wants to do whenever it wants to do it. Now, we do know that we had a great year last year. You can see 2024's returns right here. I hope you got some valuable information out of this video. If you have not done so already, I want you to smash that like button down, subscribe to my channel, and ring that bell to be notified when I post a new video. I thank you and wish you good trading.